guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is multifamily expert Will Matheson. Now, since the start of 2018, Matheson Capital has completed over a dozen acquisitions, invested in over $120 million in multifamily real estate. In the 5 years since their first purchase, they have completed another dozen multifamily student housing acquisitions valued at over $100 million. And so, guys, with that, I'd like to welcome Will Matheson to the show. Will, how you doing today?
Doing well, Kevin. Thank you for having me.
Excited to have you here. Excited to peel back the layers a little bit, peel back the onion, I guess you could say, of your business and get a better understanding of not just the business, but also you. And I know it's your twin brother that's in the business with you. And so why don't we start there? Why don't we just go back in time a little bit, Will, and fill in some of the gaps about your background, what you were doing before real estate, and then ultimately how you found your way into what is today, an investment group known as Matheson Capital.
Yeah, so prior to Matheson Capital, there's really not much to say before real estate unless you're going to go back into college. My first job out of undergrad was being a broker at Marcus and Millichap. I was doing it in Raleigh, and my brother was doing mortgage brokerage for Marcus and Millichap in New Jersey for a while. And we said we really wanted to work together. He came down to Raleigh as well, did that for a couple of years. And, it was during that time, actually, 2015, we were 23 at the time. That's when we started Matheson Capital because we had a client split their 1031 exchange. They had $1 million equity shortfall. Always dangerous when you split an exchange, and nowhere to get. They had $1 million shortfall. They needed the money. We knew their entire portfolio, so we said, I think we can raise this money, put a first loan on one of their own properties, and give them the liquidity they need. Did that really quickly, and that was the start of the company. That lasted about 16 months before we got paid off. Um, and then, yeah, like I said, we did the brokerage for 2 years, and we decided we really wanted to own more as opposed to brokerage. So we left. We attended Columbia University's Master's in Real Estate Development program, year-long program. Highly recommend. Great place. Meet a lot of great people. And yeah, it was when we were leaving that program, we decided, let's do this full time. Let's start buying as opposed to climbing the corporate ladder for the next 10, 15, 20 years. Let's start small. And we did with the duplex. And, by the time we're 30, 35, whatever it may be, we'll have our own portfolio of, institutional quality assets. So that's the backstory.
Okay. No, fantastic. I appreciate that. And, first question that comes to mind is I guess not necessarily the transition from being a broker over, putting the investor hat on, but more so, talk to me about some of maybe the valuable lessons that you were able to, take away from being a broker at one of the large firms. I think it was at Marcus and Millichap for both the years that you were there.
Yes, it was.
Okay. Talk to me about some of the valuable, the valuable lessons and just, insights that you were able to garner from being with a group such as that in the brokerage side for 2 years prior to going out on your own.
So I always tell people brokerage is a great place to start out in real estate because it really teaches you to deal with rejection on a very, very large scale. I was primarily doing retail, so was Evan. So, you're cold calling. You'll call 50 people in a day. No one will want to talk to you. And at first, that's a lot like what it's like raising equity. You get a lot of rejection, a lot of no, I don't want to do it. Not quite as tersely as in the retail brokerage side, but there's not any one advantage to, there's not any one lesson, there's not any one advantage to starting out as a broker. I'd say the biggest thing is, as opposed to coming from, let's just say, an accounting background or, just any other corporate job and then switching over to real estate, the big advantage is you're getting paid to immerse yourself in real estate. And, what do you do when you start out as an investor? You're immersing yourself in real estate. It's not taking, an HR job and putting it into investing. It's taking a job that literally deals with investments all day and translating it to investing. So that's the big advantage.
Okay. And I know that Marks and Millichap, they've got a pretty robust training program as well that they send all new brokers through, correct? I've heard it's great. I've
Yes.
heard it's great. I've never personally gone through it myself, but I've heard it's actually a great program as well. And I think it probably teaches you about the rejection, basic sales skills and cold calling techniques and skip tracing owners and all that kind of stuff, correct?
I mean, I will be honest, I actually went through very little of Marcus and Millichap's program. It was a
Okay.
very unique situation in my region. My boss at the time, my senior broker, was very adamant about he wanted to teach me hands-on. He didn't want me going into the pool with everyone else. So he was very hands-on. He was a top broker in the region. I learned a
Well, there
lot
you
from
go.
it, but
Yeah, top
yeah, so
broker in the
I
region. I'd
missed
rather
that.
take it from him, right? I'd rather have it, be real world than theory in a classroom.
I mean, they say one thing about Marcus and Millichap, they do teach you to get on the phone.
Yeah.
That is one thing that is I think that's a valuable life skill. We were doing interviews for some new hires earlier this year, and we had one guy with door-to-door sales experience interview with us, and I told him, "Okay, look, for various reasons, this isn't for you, but you should go become a broker because if you can get told no to your face, getting told no on the phone is just not even a thing."
Yeah, yeah. Are there still what gets sold door to door nowadays? I mean, I haven't had a vacuum guy come to my door in probably like 10 years. So, but no, just but I agree with you. I mean, seriously, if you can go in person, like not number one, like half the neighborhoods in this country probably have no solicitation laws. So if you're willing just to kind of blow past that and be like, whatever, I'm gonna go in here and do this anyway, knock on doors and get yelled at the entire time. Yeah, I mean, it builds some really thick skin, and I'm sure that goes a long way, in being a broker or just any other endeavor that you're going to encounter in life. Seriously. So, no, that's that's great advice. So, you were a retail broker, made the pivot over to multifamily. How did that pivot happen? Give me the process that you went through in order to decide upon which asset class you guys were going to focus your time on.
So, we had some limited exposure to multifamily and student housing as brokers, but again, we are primarily retail. But, when we're starting out on our own, it's 2017, it's the end of 2017, it's the beginning of 2018, and all people are talking about is it's the retail apocalypse, it's the retail apocalypse, get away from that entire asset class, which, look, if you owned malls or big box stores,
Right.
I think there's a lot of legitimacy to that. I always preferred strip centers. Um, so I think it was a little overblown in that sense, but the honest answer is multifamily and student housing were an area where we felt it was really hard to mess up. It was really hard because the last thing you want when you're starting out, and again, our first acquisition is at age 25. We didn't want to have a giant black mark on our record. With multifamily, you go in there, you can, if you find, the original interiors from a 1970s property, as long as you don't massively overpay, and that's, where the brokerage background comes into play, you can get in, get out, and deliver some returns. With retail, with industrial, there's a lot of, I'd say all your eggs in one basket. You've got 5 tenants, you lose 1, you lose 2, you're in a really tough spot. Maybe you can't lease them, maybe you don't have the TI allowance. So yeah, multifamily, and that it was really a play of what do we think we can do that's the safest asset class that also offers a lot of upside.
Hmm. Yeah, no, I agree with that. And, so the market, you guys started in 2018, kind of an upward trend, and then COVID hit, and, the world paused for really just a very short period of time. And then, it seemed that rocket fuel really got poured on the multifamily industry, just the housing market in general. And all we've seen since 18 has been really an upward trajectory. And I know that multifamily is still going incredibly strong, but there's obviously been a little bit of shakeup just economically in general. The debt markets are kind of all over the place, lots of uncertainty out there. There really hasn't been too much of a reprice, or too much movement in the cap rates on multifamily, generally speaking. But again, I think there's still a fairly significant delta between values to what sellers are still asking, and so transactional volumes down quite a bit as well. And so what have you guys done? What has your team done to really adapt to these changing times over the last 12 months or so? I mean, have you actually made any acquisitions in the last 12 months since the start of kind of the craziness with the markets?
Yeah, so since the start of 2022, we have made 3 acquisitions. 4, one were a smaller piece. So 3 where we're really spearheading it. We've made 3 acquisitions since then, and we have another one that's under contract. It'll probably close before the end of June. The big the big difference, I mean, the big difference I would say, obviously, the debt controls a lot of what you can and can't do.
Hmm.
And in some respects, we've been a lot more focused on, let's just call it newer assets, not that 70s, 80s product. Um, Two of our last two acquisitions were built in 2018 or 2008. So
Wow.
I think there's kind of a flight to quality. I think a lot of value add, not to say all value add, but a lot of value add is kind of played out at this point. There's been four owners in the last 10 years. They all had their value add plan. So now you're just doing a fifth series of value add. It's a very rent burdened segment of the market, whereas Class A is statistically less rent burdened than anybody else. So, we've definitely shifted away from some of the value add. We're a lot more skeptical about some of the value add, and we've, the flight to quality you always hear about. We've
Yeah.
definitely been a part of that.
Have you noticed that you got a deal right now that's in contract that's going to be closing, you said towards the end of June. And so if you, compare apples to apples of maybe what that might have traded for same time last year to what ultimately you guys have it under contract for, you don't have to disclose that, but just do you think that it's below what it would have traded for a year ago today? And if so, approximately how much?
Well, it gets a little complicated because it's a loan assumption with
Oh, okay.
3.3% debt, so it's
Right.
not quite comparable. But I mean, the cash on cash I mean, the debt service coverage ratio, let me use that number, is 2.4.
Mm-hmm.
I don't think you find something with a 2.4 DSCR if rates stay the same. I just
Yeah,
I just don't
I
see it
agree.
with the rates
No,
going up.
I
I
agree.
think you do see that adjustment in value.
So is that where maybe some of the opportunity lies then is this looking for those for XYZ reasons. I don't know the reason why this current seller is disposing of this asset. It could be a litany of reasons. Maybe you know what they are. I don't know, but um, could there be an opportunity for folks out there to really look for maybe some of those pain points, not necessarily in the deal itself, but a deal that maybe was bought in the last couple of years, has got some good Fannie or Freddie debt in place, low rates, still has 7-8 years of term remaining, maybe a IO term remaining as well, to get in and get in at with some incredible debt terms and helping that seller exit out of that asset again for whatever reason they need to get out of it. And if you know the reason for the one that you're buying of why they're selling, I would love to know as well, because I think what we'll see is there's going to be a number of probably partnerships that ultimately have to dispose of some assets just to create some liquidity, maybe for offset a few other projects that might be a little bit more challenged that they have in their portfolio. But we'd love to know if you've got any insights there on this particular deal, and then also is that an opportunity that you guys intend to maybe put some more resources behind?
So what you just said is, as I understand it, why the seller is selling. They're just trying to increase liquidity for the rest of their portfolio. So
There
they're
we go.
selling a
Yeah.
very sellable asset, like the one we're buying. It's very sellable in order to transition their focus towards some other assets that maybe aren't as sellable at the moment. Take
Mm-hmm.
your winnings, so to speak, and shore up anything that may or may not have bridge debt on it. As to the other question you asked, I do think loan assumptions are going to be a really big opportunity in the coming few years. I mean, anything that has that agency debt, that fixed, sub 4% with interest only is going to be very, very appealing. And another thing you mentioned is, properties that, it's what everyone's been waiting for, are the properties that don't have anything wrong with them from an operational perspective, from a property perspective. They have capital stack issues. What,
Yeah.
everyone's been, oh, the bridge debt bubble, the interest rate cap bubble, it's going to be Q3, it's going to be Q4. It seemingly always gets moved back. But I do think there will be a lot of opportunity in that range. Although I do have to say, from conversations I have with a lot of people, you know, I'm not sure how green the buying environment is going to be
Mm-hmm.
in the back half of this year because seemingly everybody, 80% of people, are saying, yeah, we're going to keep our powder dry when all these loans come due. Then we're going to get involved. Well, so is everybody else. The demand is going to be out of control.
Sure.
That's at least my take.
Yeah, I agree with that sentiment. The only caveat to that, I think, and I can only state this from personal experience of when you're actually in the trenches, like it's really hard to know, like, is today that day that's a good day to buy, right? Especially if we start realizing additional turmoil in the economy and more negative headlines, and the markets start taking the deeper dive and what have you. It just a percentage of those folks that are just, I'm waiting on the side with dry powder, when it's time to actually act, they won't be decisive enough to actually take action. So, but that's still, it won't be the majority, but there will be a segment of those individuals that would automatically eliminate themselves from the game, because they just won't be able to make a decision at the point in time, because they don't know if it's the right time still, while everyone else is out there actually taking action, executing on deals. So, but
Yeah,
it's
I
hard.
mean,
It's
my
hard.
general,
It's hard when you're in the middle of the mess.
I mean, so my general outlook on acquisitions right now, the few of them that I've seen hit the market, there was a deal brought out by CBRE down in South Carolina recently. On market, they went through the process. I swear there were 20 bidders on it. Like, it was incredibly competitive
Uh-huh.
just to get a shot at it. And, we didn't end up prevailing on that, but it's not like in 2008, 2009, everyone was all of a sudden flooding back to the market. Oh, look, prices are down, et cetera, et cetera.
I
Let's get
agree.
in there. Like, people were incredibly skeptical. And, if we do have a recession and interest rates get cut, you'll see the exact same thing. Everyone's not all of a sudden going to say, oh, yeah, time to buy. This is
Right.
great. No, you're going to see that skepticism.
I mean, it really, realistically, it took. I mean, I just, again, this is just my personal experience, and uh, I feel, I started buying again in 2011, and I took a couple years hiatus from '08 to 11, and we started buying again in 11, and it's pretty slow. I mean, like, again, there was a lot of I mean, it was still like the recovery barely had even started. I mean, it was still disastrous. There's still lots of REOs and things like that kind of working their way through the system, but um, I really didn't notice much of a major uptick until like 16 and 17, to where, like, literally like there was a noticeable difference of folks getting into the space, and a noticeable amount of competition on deals. Prior to that, it's just, if you had capital and you had the wherewithal and you had the balls to actually take down an opportunity, whether it be a multifamily or in the manufactured housing space, what have you, a lot of times, if you're willing to pay a fair price and you could actually get the deal to closing, it was yours to be had. And that surely wasn't the case, again, just through my eyes, 16, 17 and thereafter, it just got a lot more competitive. And then, 18, 19, 20, and we know what all happened there. And even to today, just lots of liquidity chasing after multifamily, and lots of competitive buyers in the space, lots of institutions in the space. Consolidation continues to happen. Same thing that we're seeing in the manufactured housing space. 5 years ago, 5, 6, 7 years ago, there was no institutional competition to speak of in our industry at all. There were a few bigger players, but the consolidation factor was not really a thing. And fast forward to today, there are billions of dollars worth of institutional capital trying to rush into our space, and have been over the last couple of years. Unfortunately, we don't have a lot of new product coming online, so it's a very different industry than that of multifamily, where there's always new product being built. And so we've got more and more competition fighting for a limited supply of opportunity. So it's not the greatest position to be in when you're trying to buy deals at a fair price, but either way. So next steps moving forward for your group. You guys are actively buying now. Any pivots that you've made, that you're going to make, that you intend to make here as we go down the next 12 to 24 months? Again, just well, actually, let me back up because I know, just through other conversations I've had, and also personal experience, the general sentiment with retail investors, some read too much into the headlines. Some just don't know, economically where we're really at. I mean, just again, speaking to the uncertainty in the marketplace, and it seems as though, and what I've gathered from others as well, that it's been a little bit more difficult to raise capital. And my guess is that will continue. That difficulty will continue, might get even worse over the next months and couple of years if we continue going the direction that we're going. What are your thoughts on that? And ultimately, any adjustments that you're making within your business to adapt?
So, I mean, I don't think it's really been, yeah, there's no disagreement. It's going to be harder and harder to raise capital from a retail perspective. I mean, one of the ways, we're going to continue building out our capabilities to do that, our investor base, things like that. That's why we do shows like this. It's why we do all these other things. But not only that, we've also, in October, we closed our first joint venture with a private equity firm. We're working on some other joint venture opportunities right now. Just again, it's, depends on the asset, depends on the market. But if you're fully reliant on any one group of retail investor, I think that's always difficult. That's why we're building out our private equity joint venture side,
Okay.
so to speak.
Any lessons learned to speak of with that first relationship? I mean, maybe how you would have if you'd have done it differently, the structure wise, or part of the negotiations. I mean, just any additional insights you might have there.
I mean, it's just different than working with retail investors. I mean, obviously, when someone's bringing 85, 90% of the money, they have a much greater ability to dictate terms. Whereas, if you go out there, you're syndicating a property, you say, this is the preferred return, this is my fee, this is X, Y, and Z. You know, you're getting 100,000 here, 50,000 there, 200,000 there. No one really can say much about that. But when you're working with a private equity firm, it's really about the terms they're dictating,
Mm-hmm.
more so than anything else. And, to put it bluntly, that's completely understandable. They're bringing 90% of
Yeah.
the money.
That's right. I agree with you on that. I mean, what was the path looking? What did the path look like to get there to that relationship? You guys have only been at it since 18, and did they come looking for you? Were you out there proactively seeking a potential JV partner for deals that ultimately that you need to take down that you wouldn't be able to do with retail capital? Just how'd that start out?
So we were actively looking to syndicate the property. And then a partner of ours up in New York said, hey, look, I really think you should talk to this group. It'd be a great opportunity.
Mm-hmm.
So it was a good partner of ours who we've worked with, 4 or 5 times. As of right now, they said, look, we know these guys. They're great. You should work with them. Um, that's how we ended up in that situation, and it was a great opportunity for
Good.
us, really. It's one of those things, as soon as you work with one, you have that shine on you, you have a lot more legitimacy. You gotta get over the first hurdle, so to speak.
I like that. You got that shine on you. So is it a pretty defined buy box that they're looking for? Region, class of asset, all those factors. I mean, do they define what it is you're looking for, or how does that work?
Well, so we don't go out looking for investments for any particular partner or any particular, even though we did the joint venture on that one group, that doesn't mean we have to do every deal with them. Obviously, we talk to them every time we're doing an acquisition, but
Yep.
something might not be a fit for them. It might be a fit for somebody else. It's not like a vertically integrated. Now we're just
Got it.
hunting for whatever their next project is. So we look for stuff that we think makes sense to us. And so far we've been very fortunate that we've been able to find investors that agree that it makes sense for them as well.
Yeah. No, I agree with that. Appreciate that insight. For those Will that want to learn more about you and your group, where's the best place to find you guys?
So I'm pretty easy to find on LinkedIn. Will Matheson, Charleston, South Carolina. There's also our website, mathcap, mathcap.com. Just a shortened version of Matheson Capital.
Okay, fantastic. Well, I appreciate you joining us today. It's been a lot of fun having you and learning about your business.
Thank you for having me, Kevin.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, that's your host, Kevin Bupp, wishing you huge success. Take care now.